Welcome, welcome everybody. Welcome. As you guys are starting to trickle in, we'll give you guys some few minutes to get in, get settled, get your audio set up. We've got quite a few of you that's going to be joining us tonight, so we're excited to get started, but we want to give you just a couple minutes to get ready. Brenda, Derek, it's so good to see you guys on here. Jeremy, I love seeing your guys' names and the fact that you're able to join us tonight. I love it. Pedro, this is awesome. All right, we'll give a couple more minutes for everybody to come in, but in the meantime, I'll go ahead and tell you a little bit about not only who we are, what we're going to be talking about tonight, the benefit, but how long you guys are going to be with us tonight. So I first and foremost want to thank these investors that sent in these questions. These are phenomenal, and I know that you guys are going to benefit from us asking the questions that you guys wanted to know. So thank you for sharing exactly what it is you guys are looking for. Now, some of you know who we are, some of you don't. For those of you that don't, I'm Melissa Forbush. I'm with MF Capital Partners. We focus on the acquisition and management of opportunistic and value-add multifamily properties, ultimately giving you guys a safe place to put your money to work and receive and provide the high yield returns that you guys are looking for. So that's what we do. I'm VP of Investor Relations, and I have Jamel Nelson here. He is the founder and managing director of Nelson and Associates. He specializes in accounting, tax, and advisory services for real estate investors and companies. So y'all, he is able to leverage his skills and wisdom that he developed early on, and it's given him a deep understanding of the specific client requirements, which I know you guys are wanting. So this obviously includes when you guys are looking to identify and understand not only compliance, but strategy, growth, and then also advancement opportunities. So this is what you guys requested. You guys wanted to make sure that we could show you not only what to ask, but the boxes to check off to make sure that your CPA has not only the experience, but the expertise for real estate investor tax planning, which is the lovely time of year when we all get ready to hopefully pay as less or as little amount of taxes as humanly possible while still staying fully compliant. So y'all, that's why we're here today. We're going to make sure that Jamel is able to share his wisdom, his experience, and we can help you guys fully take advantage of the tax benefits of real estate. So without further ado, just a couple more things. I want to first shout out Tasha. She is our incredible rock star who's going to be manning the chat. She's incredible. She is going to be dropping the links. Obviously, you guys know about our investment opportunities. Our current investment that some of you are familiar with is the MF Aloha Fund. Now, if you're not familiar with that, you're going to want to be. So it's an opportunity to diversify your investment with some of the most experienced operators in the industry. So Tasha, she's going to be putting the link in the chat for you guys to gain access and receive more information regarding that. So you'll have those links throughout this call. Now, y'all, are you ready to dive in yet or what? Now that I, spit all of the logisticals, I don't know if that's an actual word, but we're going to go with it tonight. But we're excited. So again, we're going to talk about really what makes a qualified CPA to have a real estate client. But first, I'm going to let you guys know, if you guys stay on, Jamel has offered to give his book available to our attendees. So it's called The 7 Financial Mistakes Real Estate Investors Make. I'm super excited for you guys to get your hands on that as well. And during this call, if you have additional questions that you were not able to submit, feel free to drop those in the chat or in the Q&A. We are going to be pulling from that throughout the webinar, so feel free to do that. Now, let's dive in. All right, Jamel, we're so excited to have you. Thank you so much for jumping on and being willing to share. We're super excited.
Absolutely, absolutely. Love the energy, love the excitement, and I'm actually pumped to be on the call with you all today.
Awesome. Okay, I'm going to start out with really the question that everybody on this call is asking, because I received this question from at least 4 different investors, 2 with the same name. John, I'm talking to you. All right, how are CPAs different, and which type is best for real estate investors?
Absolutely, that's a very great question, and to actually kind of set the tone when it comes to providing a response to that question, I think it's really important to understand what a CPA is, why you should even consider a CPA, and what the other alternatives are. And then based on having an understanding of those different options, then it may help guide you with regards to what you're looking for in your specific need. So first off, when it comes to a CPA is going to be someone that is granted that license or that designation because they have a couple things. They have the education background, they have the work experience background, and then they also passed a really grueling test, which is going to put them in a position to get the license. Now, after you identified the individual with the CPA, then there's multiple areas that someone could service by having a designated license as a CPA. And they could actually work in public accounting, they could work as a tax preparer, they could work in corporate accounting. So not necessarily it is the case that all CPAs are equal. Certain CPAs do not have any dealings with tax. Some CPAs despise tax. So the fact that you have someone that says they're CPA or has the designation as CPA doesn't necessarily mean they're the best fit for you. So that's the first thing that I want to address. And aside from an individual being a CPA, you may have others that are not necessarily designated with the title of a CPA. You may have some individuals that are listed as an EA, an enrolled agent, which is actually another designation for someone that specializes in taxation. You may have someone that doesn't have a CPA or an EA, but they may have the experience to do the work. But ultimately, when you're looking at a CPA, what's going to allow that individual to have that title is the fact that they have the educational experience, they have the work experience, as well as they passed a test.
I'm a little embarrassed to admit that I had no idea that there were CPAs that wouldn't be dealing with tax specific. I just assumed.
Absolutely,
That's crazy.
absolutely. And when I actually started my career out, I actually started out at the Big Four accounting firm. And the whole idea of the Big Four accounting firm is we're public accountants. And at no point in time did I touch anything tax related. It was all corporate accounting, financial reporting, 10Qs, 10Ks. And if it did require any accounting, then we had a separate department that was specialized in, if it did involve tax, we had a completely separate department that had tax specialists or individuals that specialized in that. So just to kind of give you an idea, when I first started my career, I started off as a staff accountant and I moved my way all the way up, but it was as a auditor, not necessarily in a tax specialist. So again, that's another example of how you could have a difference in the type of CPA you're working with.
Okay, so I actually want to know from you guys, how many of you did not know that? Am I alone? Maybe I am alone, but I had no idea. Obviously, I knew that different CPAs specialize in different areas, but I just assumed that every CPA would have some sort of touch with tax. I mean, I feel like in college, they're like, listen, who wants to do taxes? And you guys are jumping up and down. And then the rest of us are in the back going, absolutely not. Okay, I'm alone. I thought all CPAs. See, Lucy, I'm not alone. Dang it, I knew this. That's awesome. Thank you for teaching us. See, in the first 5 minutes, did you guys even know you were going to get this valuable of information? It's awesome. Thank you. So, okay, it kind of goes into this next question, which this is from Luke. I know that he's on tonight. So, okay, he wants to understand the difference, and you kind of touched on this, between real estate professional and non-real estate professional. What is that status and how it impacts your non-passive versus passive income?
Absolutely. That's a really good question. And this is an important concept that needs to be understood in order to really understand what your leverage is when it comes to utilizing the tax code to benefit you in regards to reducing your tax liability. So in the eyes of the IRS, they have this term called real estate professional. And when we throw the word real estate professional out, we're not necessarily referring to someone that has gone out to get an education or a certificate in real estate sales or real estate development or anything along those lines. Essentially, all we're referring to is, are you qualified and categorized as a real estate professional to put that on your tax return? And according to the IRS, in order to qualify for a real estate professional status, there's a few requirements that need to be met. And without getting into all of the details, the three requirements that you typically need to be aware of is that you have to materially participate in a real property or business trade. You have to contribute more than 50% of your time in this real property or business or trade. And additionally, you have to have at least 750 hours of time that you contribute to this real property, business, or trade. If you're able to qualify or meet those three requirements, then you essentially can qualify as a real estate professional. And the benefit of this is that you're now able to identify any investments that you have as a real estate investment. And you can potentially, after you run your numbers and identify potential losses that you've incurred, not necessarily real cash flow losses, but paper losses, such as factoring in your depreciation expense, et cetera, you can combine all of those losses and they can now offset your sources of all your sources of income when it comes time for you to now determine what your tax liability is. And if you're in a situation where you qualify for this, you're now able to really make the most of your tax deductions as a realtor investor. The alternative is, if you do not qualify as a real estate professional, then you would now still account for all of the losses of your portfolio, but you're not able to take those losses and offset them against other sources of income that may be considered your primary source of income, such as your W-2. So what happens is you can still identify those losses, but you'll have to suspend those losses and only offset them against other passive income or sources of income. They cannot skip over to the non-passive portion of your income. So that's the key piece when we throw the word real estate professional rep status. That's what we're talking about.
Okay, so how do you know if you're, I mean, all of our investors right now that are on this call, some of them have invested with us before, some of them haven't yet, but they're looking for depreciation.
Yep.
So if now is the time, I mean, Tasha and I speak to investors all the time where they'll come back and say, my accountant is unfamiliar with how to really work this depreciation. So
Yep.
How do they know, as a passive investor, how can they determine that their CPA is actually maximizing their tax position while keeping them safe?
Great question. So to ensure that you're getting the best service and the best guidance, first off, it would be a very, very reasonable expectation to potentially ask about the professional that you're working with, of their experience. What is the experience of working with other real estate investors? Do they have other clients that they service? And specifically, how can they assist with determining and identifying depreciation opportunities? Depending on their response, that will give you a good indication as to if they have familiarity and if they're able to be competent with guiding you in the right way. Another point is, we talked a little bit, we opened up about the different types of CPAs. So obviously you have CPAs and individuals that have designations and experience. However, not all CPAs are created equal. And to that point, not all tax CPAs are created equal. You may have a professional that is considered a CPA and they may be specialized in manufacturing. That is completely different than real estate accounting. And the reason you as a real estate investor are not interested in going to a CPA that only works with and have experience with manufacturing companies, you're not dealing with cost of goods, so you're not dealing with that type of activity on a daily basis. Whereas if you're dealing and working with a real estate experienced CPA that primarily works with real estate investors, they will have the insight, the ability to spit out researched items. They have the history of scenarios that they're dealing with their clients on a daily, ongoing basis. And the fact that you're now in their circle and in their realm, you're going to benefit from all of that experience. And it's going to be specifically specialized and tailored to your situation as a real estate investor. So that's the key when identifying opportunities and individuals to work with. But more importantly, the basic starting point is to really ask the questions, hey, what is your experience? And how do you work with individuals in my situation? And what would you say is the number of clients that you have as real estate investors? And if they say I only have one, maybe two, maybe a handful, that may raise a flag in terms of they may have the experience, but they may not necessarily be the expert.
So I'm curious as to how many, those of you that are on this call, how many of you have asked your accountant that question? I know I didn't. I didn't in the beginning. It wasn't until I started to realize that, wait, you're not using my K1. We're not using that depreciation. Why are we not utilizing that? It wasn't until I missed out a couple of years, that's when I started to ask those questions. So I want you to tell me in the chat, how many of you have actually asked your accountant ahead of time, or do you have the same accountant this whole time? Okay, I don't see a lot of them advertise themselves as real estate investor CPA. So that's a good point. I think that's why, at least for me, it goes off of referrals. What would you say, Jamel?
Absolutely. So this goes to the idea of oftentimes when individuals start out their career, their profession, they may start off, especially when they start off their own firms or their own practices. Unless you're working through a larger corporation or company, ideally you're going to work with someone that's considered a CPA, and they may just be a generalist. And the fact that this individual is a CPA, you not being the CPA, you have full confidence, you have the expectation that they are going to be able to help you out in your specific situation to the best of their ability. However, unless that individual you are working with says, I actually specialize in this area, chances are they're not a specialist, they're just a generalist, and there's a difference. So ultimately, going back to the question, what type of clients make up the realm of your clientele? Are they across the board, or are they primarily within this specific industry that I need assistance with?
Yeah, that absolutely makes sense. So in your opinion, how much time does your CPA spend working with clients and their tax strategy? Is that something that, as a passive investor, we should be looking at them spending the majority of the time on the tax strategy, or what would you recommend?
Yep. So to better address that question, I think it's important to really understand the difference between tax preparation and tax planning. Mm-hmm. So tax preparation obviously is filing your tax return, understanding what your due dates are, and completing those forms completely and accurately. That is a compliance issue there, and that is related to compliance. The second alternative is, in addition to your tax preparation, you also have tax planning. And tax planning is also along the lines of advisory, consulting. If you're only tax preparing and filing your tax return without being proactive in identifying identifying specific opportunities and strategies before you file your tax return, chances are you're not tax planning and you're not getting tax advising services. And those are two separate services and two separate things that you as an investor, when speaking with your professional, need to identify. And you need to question, okay, am I getting my tax return prepared? Am I getting tax advising services, or am I getting both? And 9 times out of 10, if an individual is not proactively questioning or requesting a tax plan or tax advising, they're likely not going to get that tailored hands-on approach. So those are the two different things that are very, very important when it comes to making sure that you're taking control and you're being proactive with making sure that you're getting the most out of your tax efficiency. So those are very, very important. And oftentimes in my experience with my firm, before we contract with any client, we explicitly state that, hey, we offer tax compliance, we offer accounting services, we offer tax planning. Those are 3 separate services, and this is why you should consider if you're in the situation that you're in. And if it makes sense for you to tax plan, then you should highly consider, in addition to filing your taxes and being compliant, you should also maybe consider doing a tax plan. And my recommendation to those that are not familiar with the tax plan or the process of a tax plan, do me a favor, when you get a chance, take a look at your most recent filed tax return. And I believe it is row or line 24 of your Form 1040. That line actually indicates how much tax you're on the hook for. And if that amount is 15% or less, chances are you're doing okay. You probably are efficient with your taxes. But if your amount is between the 15 to 25% range, chances are you really need to consider having a tax plan done or having your professional speak to you about your tax planning strategy. And if you're 25% or more on that line, you're essentially in emergency 911 mode. Like, you literally are leaving money on the table, maybe tens of thousands of dollars of money on the table, especially if you own a business or you have real estate investments.
I don't know about you, but I'm about to pull my taxes out immediately. That is incredible. And Lucy brought up that most CPAs actually only do tax preparation.
Yep.
So that's true. I mean, it's okay. Remind them what line that was on the 1040.
I believe it's line 24.
24. Y'all better be making some
yep.
notes. Take these notes, you guys. This is incredible. He probably just saved you thousands of dollars. This is awesome. Okay, so along those lines, how do you know? I mean, we talked about what to look for, but what are the warning signs? So if you are working with a CPA, what are the warning signs that investors can look for that their CPA aren't doing them any favors?
Yep. So a warning sign is, now that you understand there's a difference between tax planning and tax preparation, the warning sign is if you're working with a professional and the only time you communicate and hear from them is during tax planning or tax preparation time, which is around the March, April timeframe, chances are you're working with a generalist, or chances are you're working with someone that focuses primarily on tax preparation. And at the end of the day, we all have to be compliant. We all need to file our returns. We all need to report our taxes, but that's not doing you any favors with regards to making sure you're being the most tax efficient as possible. If that individual is not offering you tax strategy, if they're not talking about what are your goals, if they're not talking about any goals or plans that you have for acquiring investments, retirement, if they're not having these conversations with you throughout the year, chances are you're not informed and you're not going to take advantage of the opportunities available for you. And at the end of the year, if you cross over past December 31st to the following year, chances are a lot of your opportunities to tax plan have now expired and ended. And you're now not going to be able to take advantage of a lot of the opportunities for that tax filing period for when you file your taxes in the April period. You'll now need to focus on the new year, the upcoming year. So if you're not having a conversation specifically about advisory, consulting, and planning, which typically is going to happen several times throughout the year. If that isn't happening, chances are you're not working with someone that's specialized in strategy and making sure you're, again, being the most tax efficient.
Okay, so Adele asked, what were the percentages again? I believe you said 15%.
Yep.
You're okay.
15%, 15 to 25%, and then anything over 25%, you're definitely in need of dire help.
To say it nice. Okay, so let's start diving into more of the real estate stuff. So my question to you is, how, as a CPA, how do you approach what should be written off versus depreciated?
That's a great question. That's a very technical question. The way that I approach it is, first, we need to understand there's a difference. There's a situation in which you're immediately, as you have an expense, we're going to include it as an expense and it's going to immediately be deducted. Whereas if we now need to depreciate, this is now going to involve us considering the purchase or the acquisition that we acquired. Was this considered a capital improvement? Was this considered a general expense? And if it is considered a capital improvement, chances are this is likely needing to go through the process of determining if it should be depreciated or capitalized. So an example of an item being depreciated versus just being automatically written off, we can look at the dollar value sometimes, and then we can look at the purpose and the intent for the use. So oftentimes, if we have an individual that is a real estate investor and they may be doing renovations to their property and they're spending several thousands of dollars for these renovations, chances are this is improving the value of their investment. This is now increasing the value of that investment. That is not going to be considered an expense generally. We're now needing to identify how much did we actually put into this renovation, and based on that, how are we going to depreciate it? Are we going to depreciate it over a straight line period, or are we going to maximize our depreciation by front loading it in the early portions of the year? And the key here is you cannot depreciate your expense, or if you have an expense, you're immediately going to write that bad boy off. But if you have capital improvements, expenditures, things like that, unless you follow specific guidelines such as bonus depreciation or things like that, you're typically in a situation where you're going to have to straight line that item. So those are the differences, and those are the keys that your typical generalist may not be aware of. And ultimately, this is where a lot of people get in trouble, or if they're not working with a professional that's expert in this area, they could have situations where they now may have either applied the wrong tax accounting treatment, and or they may potentially not taking advantage of some of the deductions that they could have, which is a unfortunate situation.
Absolutely. And I know a lot of you are looking for depreciation. That's what the bulk of Tasha and I's conversations with you guys, you're looking for ways to really decrease your capital gains and take advantage of that. So just as a reminder, if that is something that you're interested in, make sure to click on the link that Tasha has put in the chat. That is going to give you the ability to tap into some of these benefits that Jamel has shared, because that is such a focus for us. We know that our investors are extremely concerned and want to make sure that there's depreciation involved in their investments. So I know that the bringing up cost segregation and accelerated depreciation and bonus depreciation, this is such an in-depth conversation. We can have an entire webinar just on that alone. So just if you can give us a synopsis of cost segregation studies on real estate investments and why we use that for accelerated depreciation and bonus depreciation.
Absolutely. So we could potentially have a conversation on this topic for another 2 hours nonstop.
Yeah.
So there's certainly a lot of details involved, but I'll do my best to try to make it very plain and simple. I mentioned depreciation just a minute ago. So depreciation is obviously if we have an asset, that asset is not expected to survive and live forever. It's going to have a lifeline. And the IRS, when it comes to real estate, we can either depreciate over a 27.5 year period or a 39 year period. And that's a general straight line depreciation. So the difference is.
I have to ask you right now.
Yep.
I mean, my husband and I have this argument all the time because I say football players have a deadline. Just
Yep.
like with assets, there comes a day where they're not as valuable. And he comes back and says, look at Tom Brady.
Yep.
He never has a deadline. That man is still cruising down the field. So, I mean, before you keep going, that's the only thing I could think of as well. I mean, except for Tom Brady.
So I'll say your husband is right and you're right. When it comes to real estate, we have a expiration date on the actual building itself, the actual physical, and the land itself, it doesn't have an expiration date. So here's another key. Here's another key. When acquiring a real estate investment or property, you're going to have two things you need to account for. You're going to need to account for your actual purchase price. And from that purchase price, we're going to break out how much is allocated to your building and how much is allocated to your land. So the building is the portion that we now can identify as the asset. Land, unfortunately, is not depreciable, but we still have to account for it because it helps us determine how much we can now start with in terms of depreciation. So typically speaking, if we were to depreciate over a straight line or over a straight line period, we're going to do that over a 27.5 or a 39-year period. And based on what our scenario is regarding our allocation, that is the possible potential that we can now identify expenses on our tax return. So typically, if someone purchases an investment property, they're going to benefit greatly because they now didn't necessarily have to come out of their pocket to realize this expense. It's just going to be something that the IRS now allows us to take because we have an asset and it's depreciating. So they give us the opportunity to have a phantom expense or what we refer to as a paper loss. So because we now have this paper
I like
loss,
phantom experience better.
So because we have this paper loss, this is why it's such a huge benefit of having real estate, because the more real estate you own, the more of these expenses you can accumulate. So this is the general concept of depreciation, but where cost segregation is really important. Cost segregation allows us to be able to not necessarily depreciate over a 27.5 year period or a 39-year period. We can actually depreciate over a 5-year, 7-year, or 15-year period. But in order to do that, there's a process that needs to be followed, and there is a study that needs to be performed and prepared so that you actually can identify, okay, I have this asset, I have X value dollar amount attached to this asset. Of this asset, it's not going to depreciate over 27 years or 39 years. Ideally and realistically, I now need to identify different pieces of my asset that are going to fit in the 5-year, the 7-year, the 15-year bucket. And based on my analysis, I now have the documentation. I now have the proof and the evidence that this was a performed study. This was documented. Now I can take those depreciating items and assets to recognize as a deduction on my tax return. And this is where you working with your CPA that again is experienced with this is going to come hand in hand. Unfortunately, if you're working with a generalist that is, again, is in the manufacturing space, they may not have enough an understanding or even know what a cost segregation study is.
That's awesome. Okay, that makes total sense. Thank you for explaining that in layman terms. That's what the rest of us need when we bring up these topics. I see a couple of our investors, their eyes glaze over and they're like, listen, just tell me how not to spend my money at the government. That's all I want. I'm like, all right, we'll keep you compliant. That's our goal. All right. Well, here's a question from John. He says, would you have a CPA for your personal self and your business, or a different one for a property LLC?
That's a great question. You certainly can have a separate professional to assist in separate areas. But my recommendation, and from my perspective, if you can identify someone that can handle the full gamut of your situation, the better you will be, because that individual can now better suit you when it comes to really providing you guidance and having the background and the history of your tax situation. And again, if it's a matter of just being compliant and filing your tax returns, you can have different individuals do that. But if it's a matter of you now being effective and efficient with your tax planning, the person that assists you with your tax plan is really understanding your full story. And your full story is going to have insight into your business, your personal, your investments. And because of that, if they're working with you throughout the year on your strategy and your plan, they can also, if they provide the service, also file your tax returns to keep you compliant. And it's not a matter of you working with a separate tax advisor and then having that person communicate with your tax preparer. So in a best case scenario, it's better to have one individual service you in those areas. But there's certainly situations in which individuals choose different individuals to service their needs.
Perfect. And then let's go back to cost segregation, because I have a couple questions that I missed.
Yep.
So here's one. If the property is older than 27 and a half years, is there room for depreciation?
So the question there is, to answer that question, the question is, or the response to that question is rather, how much depreciation has been taken to date? So regardless of how old the property is, was that property depreciated on day one? And if not, then chances are there's still room for depreciation to be taken. The second question is, even if we have not exhausted, or even if we did exhaust 27 and a half years, did you actually accelerate your depreciation at any point in that period of time? If you accelerated your depreciation, you went off the roadmap of 27 and a half years. You now may have depreciated everything in 1 year. So in order to really understand that, we need to understand what did you take in previous history, and then what do you now have available moving forward? Another point to that is, even if you did exhaust all of your depreciation efforts, if you were to increase expansion, perform improvements, again, this is where the depreciation versus expense write-off comes in. If you have any improvements in those areas and we identify that as improvement to your property, you now have increased the value of your home. So you now have opportunities to create more expenses that way.
Awesome. Okay. And then Lucy asks, our previous CPA did not suggest cost segregation because he said we would have to catch up when we sell our property. Can you explain? And then we also had another comment that's similar from Tim that says, with a target exit of 2 to 5 years, do we have to recapture depreciation or bonus depreciation when the property sells?
Awesome question. These are some really savvy questions. It sounds like we're dealing with some savvy investors. So those actual questions are very similar to one another. So I think I can address them with this response. Anytime you take depreciation on an asset, the government gives, but they're also going to take away. So if you were to depreciate an asset and then turn around and sell it, when you sell your property, you've now essentially recognized opportunities of losses previously, and now you're going to sell it for a different adjusted value. And because of that, the government is now going to require you to reconsider and reapply all of the previous depreciation taken. And this is a term called depreciation recapture. So this is not a straightforward concept, but ultimately, to make it very plain and clear, anytime you take depreciation and you don't hold on to that property indefinitely and you actually turn around and sell it, we now need to go through a process of determining what your recapture impact is. And that's essentially the government giving you the opportunity to identify paper losses, and then you now have to bring those back into the mix to calculate and essentially determine what your potential capital gains would be.
So is there a time frame regarding that, or is it just, I mean, if you do a cost segregation study and 3, 4, 5 years later you sell, will you still have that depreciation recapture?
So it depends on how much depreciation you're applying in your given scenario, and it depends on what is left at the time you sell. So anytime you do sell, we need to now consider, even if it was you held onto the property for 1 year, 2 years, 3 years, if you took depreciation at any point and you sell, we need to revisit that. It's not necessarily time dependent per se, but there is a scenario that needs to be that you all need to be mindful of when you do a cost segregation study. The whole idea of a cost segregation study is that you're speeding up your depreciation and you're grouping it into an earlier stage of your asset's life versus spreading it out over time. And if your overall situation doesn't warrant you to do that because it doesn't make sense for you tax-wise, you shouldn't do that. But if you're in a scenario in which you have an egregious amount of taxes, such as that 25% or more of your line 24 on your form 1040, if that's 25% or more, chances are we now need to consider what are our options. And a cost segregation study is a viable option. And it makes sense for us to consider that if we want to, in the given year, deplete or create and identify some expenses to offset that tax. So that's something that you'll obviously have a conversation discuss with the tax planner if you're doing a tax plan.
Of course. So Tim says, what if we hold the property for 20 to 30 years? Does that same recapture apply?
If you sell the property, yes.
Yeah. So that is okay. And then Mike asks, can we leverage 1031 exchange instead of recapturing depreciation?
Absolutely. So this is now, again, you guys are very, very savvy. So to avoid this whole depreciation recapture, the IRS allows us to do something called a 1031 exchange, where we don't necessarily get out of the tax, but what we're doing is we're deferring the tax from the existing another property. And by way of doing that, we're not necessarily on the hook for paying taxes immediately with that transaction. We can essentially defer those taxes for as long as we essentially have that other exchanged property in the form of a 1031. But if we do a 1031 exchange and then down the line sell that property, now we have the depreciation recaptured that carried over from the original property to the new property to consider. But if it's a scenario in which we're going to continue the cycle of replenishing a 1031 exchange with another 1031 exchange, we can essentially bypass or defer the taxes.
Awesome. And then Lucy just asked, can we even do a 1031 with syndication?
So that's a great question. There are situations in which you have something referred to as a DST, Delaware Statutory Trust. It acts similar to kind of a mutual fund where you may have a situation similar to a syndication. You ultimately have an opportunity to take that investment and sell it or do an exchange, yes. But each scenario is different. When it comes to a syndication, I believe that's what the comment. There's a couple of things that you need to be mindful of. You're either going to be the primary sponsor or you're going to be the investor. And typically, if you're just a regular investor, chances are you're passively invested. You're going to get your 1099 or your K1, but you're not necessarily really making the management decisions, doing the day-to-day activity of the fund itself. So in that respect, if you're the sponsor, you can potentially take the most advantage of the tax code with regards to the tax deductions. But if you're a general investor or minority investor, chances are you may not necessarily qualify as that rep status in this scenario, and you're likely need to confine any of your potential losses to your passive activity.
Awesome. Hopefully that answered your question, Lucy. That's awesome. Thank you so much for clarifying that. Okay, so before I want to make sure that we are mindful of Jamel's time. I know that we're at about 15 minutes to the hour. But I also want to give you guys one last push. If you have any questions, make sure to give us in the chat, in the Q&A. But also remember, if any of you see value in tonight's webinar, if you know someone who could benefit from valuable information like this, make sure that you invite them to the webinar. We absolutely welcome friends, family. We want to make sure and share this information, not only of investment opportunities, but ways to protect their investment. That's something we're extremely passionate about, which is why we bring experts like Jamel on to really share his knowledge. So one more question that says, what happens regarding the gains from a 1031 exchange when a person passes away?
A very good question. So the beauty of a 1031 exchange, and I'll keep it short, if someone actually passes away in the situation, the gains are now forfeited, or any other tax liability is now forfeited. So there's obviously some details around that, but in summary, that's one of the benefits that you'll get with the 1031.
Perfect. Okay, and Ram, yes, this is being recorded. We absolutely will share it with you, along with the bonus material that Jamel was kind enough to offer to you guys, which is his book, which we're excited to send out. So this will be sent out tomorrow with the recording, and also his 7 financial mistakes real estate investors make. So this will be something that y'all will want to make sure to look out for. Jeremy, I'm going to hurry and sneak your question in really quick. He says, is cash flow considered the same as income?
No, cash flow is a balance sheet item. It is a cash account, whereas income is a revenue or expense item. So revenue minus expense is your income. So cash flow is not the same as income, no.
And I lied, y'all. I'm gonna let Mike be the last question of the night. It's too good of a question to hold out. It says, is the depreciation recapture represented in the K1?
I'm sorry, is depreciation recapture considered in the K1? Yes.
Yes.
So before your K1 is issued, you actually have to do the accounting of the actual investment itself. And if this is part of a partnership, chances are you're going to form or report this on your Form 1065. If this investment is part of an LLC, same thing. If it's part of a corporation, you're going to report it on your business return, and all of the information from the overall company itself gets determined, and then based on the investors, they will get allocated the portion of that activity. So you won't necessarily see depreciation recapture specifically on your Form K1 or your 1099, but you're going to see the details, or you're going to see it included within the details of the results of the activity reported upon.
Awesome. Okay, and then this also said, or you asked about referrals. So the referrals will also be included in the replay. So that email that will be coming out tomorrow, make sure to watch that. There will be a whole goodie bag of information for you guys. So Jamel, thank you so much for joining us. Thank you for being willing to spend an hour with us on a Wednesday evening. I don't know if y'all know this, but he's got 3 kids under the age of 4. So we all know that he definitely had to sacrifice to spend some time with us, and we appreciate it. So thank you so much. And
Absolutely.
one last push for you guys on the call. Remember that if you're wanting to take advantage of not only the tax benefits, but really protecting your investments, make sure to follow the link that Tasha is putting in the chat. And remember that taking advantage of the opportunity to protect your capital with operators like us, we have your best interest in mind. This is what we want and require for all of our investors. We want to not only put your money to work, but we want to make sure that you're not only protected, but educated in how to take advantage of these benefits that we're putting in front of you. So make sure to follow that link and gain access to those opportunities. And then if you'd like to jump on a call with our team, it is on that page. Feel free to follow the link to get on a call with us as well. So again, thank you so much for joining us tonight, Jamel. We owe you. You're amazing. Thank you so much. And we'll see you guys in 2 weeks. Thanks, you guys.